Hi, I'm Jimmy. In this video, I'm going to walk through my analysis of the Walgreens Boots Alliance, ticker symbol WBA, and CVS Health, ticker symbol CVS. This is the 30th video in our series where we're analyzing all 30 stocks in the Dow Jones Industrial Average. Technically, this video is supposed to be just for Walgreens, but there's a lot of things going on in the industry, so I thought it made sense to compare Walgreen stock to CVS's stock. This is the final company analysis video in this series. Up next in the series, we're going to build the three different portfolios that we've been after: a dividend portfolio, a value portfolio, and a growth portfolio. You can see a link in the description below to all the other videos in the series. Right now there's 29. If you found us at a later date, you might have all of those and hopefully the portfolios. Okay, so both CVS and Walgreens operate retail pharmacies. Walgreens has about 14,000 locations in the US and internationally, and CVS has just short of 10,000 locations. Now, one of the reasons that Walgreens has more locations than CVS is that Walgreens recently closed its deal with Rite Aid to purchase just short of 2,000 stores. This helps give Walgreens a bit of an edge as far as store locations. This also speaks to the fundamentally different approaches that the two businesses have. So while Walgreens was off buying Rite Aid stores, well, CVS was diversifying a bit away from stores and they bought Aetna. And this difference has changed a real lot about their businesses. So this is a chart of revenue for both Walgreens and CVS. And now I kept them separate because I don't think that they should be compared side by side, because technically Walgreens' year ends as of August 31st and CVS's ends on December 31st. So I didn't want to put them side by side to make it look like we should compare one to the other. It's really the general trend of the two that I'm after. Now I have the charts scaled the same way so we can see from a numerical basis how the two companies compare to each other. But that may not do Walgreens much justice, because when we rescale these charts based on their own numbers, well, we can see that Walgreens has had a better growth rate as far as revenue is concerned than CVS has. Walgreens' growth has grown at a compounded annual growth rate over the past 5 years at almost 13%, while CVS has put up about 9%. But as you may notice, analyst estimates, those are the green bars, well, they seem to be telling a story that they expect for CVS to grow at a faster rate than Walgreens going forward. So let's look for a moment at what's happening with the two companies and with the industry in general, and then we'll try to come up with a fair value for both Walgreen stock and CVS's stock. So let's start with Walgreens. So Walgreens has been one of the largest players in the US prescription drug market for many years. Then, a few years ago, back in 2014, Walgreens goes out and buys Alliance Boots. Boots is the British pharmacy store. And overnight, Walgreens has an international exposure. Well, a few years later, Walgreens continues their push to expand their stores, and they go out and they try to acquire Rite Aid, another pharmacy. They end up losing a bid for the whole business, but as I mentioned before, they were able to buy just short of 2,000 stores. Now, this brings us to a potential issue. So the industry in general is facing a few headwinds, primarily revolving around the pricing of drugs. Now, in the United States, which is where most of CVS's and Walgreens' revenue comes from, well, drug prices have been notoriously high. Now, for a long time, they've gotten away with it because insurance companies paid a large portion of those drug costs. This allowed for drug companies and pharmacies to take their profits. But lately, the entire pharmaceutical industry has been feeling a ton of pressure, especially in the United States. Health insurance companies have begun to offer more and more high deductible insurance plans, and essentially this makes filling prescription drugs more expensive for the average consumer, at least more expensive than it was just a few years ago. So more than ever before, pharmacies like CVS and Walgreens, they're starting to be forced to compete on price and not just, let's say, the breadth of their offerings. Well, now this brings us over to something called pharmacy benefit management. And basically, this is when a representative of a company or a group deal with a group like CVS or Walgreens. Essentially, what they say is, hey, I represent this organization, this company, whatever it might be, and we want to get a group rate on medicine from your pharmacy. Again, this lowers the margins for either a Walgreens or a CVS, but in this scenario, the pharmacy benefit manager is likely to only cut that deal with either a Walgreens or a CVS. They're likely not to cut it with multiple places. So in that case, the pharmacy will take a haircut on margins, but they get to lock up volume for their business. And that seems to be a good thing. It seems to be that's where it's all heading. And they seem to be willing to accept it. So it turns out that one of the issues that Walgreens is running into is that their margins are being forced lower and they have limited leverage to negotiate with these pharmacy benefit managers. So as I mentioned in the beginning of the video, CVS, on the other hand, well, they went out and acquired Aetna. And Aetna happens to be one of the largest pharmacy benefit managers on the planet. So clearly, CVS has locked up that business. And I personally think that this was a brilliant strategic decision relative to just expanding the number of stores that they have. Then there's even more headwinds coming down for the industry. So back in 2018, Amazon bought PillPack, which is essentially an online pharmacy. So clearly, that's going to be a headwind. Plus, you have companies like Walmart, Google, Berkshire Hathaway, Apple, JP Morgan Chase. They're all doing different things to take a swing at the industry. So we're going to have to see how all of that directly competes with both CVS or Walgreens. Many of them are talking about focusing on the insurance side of the business, but either way, we're going to have to see how all that shakes out. Wherever they go, they're going to have a lot of pricing power. Now, with all these industry problems in mind, I think that CVS is making more moves to become the dominant player in the industry. But I don't want to make it sound like Walgreens is just standing idly by. They have deals with LabCorp, Kroger. They have a deal with, they partnered up with Birchbox recently. They also cut a deal with FedEx, so you can now pick up or drop off packages at Walgreens for FedEx. So they're doing what they can to balance out their own business. So that's the overall industry backdrop. And clearly the industry is taking some hits, and both CVS's stock and Walgreens stock have the lumps to prove it. This is a chart of Walgreens stock over the past year. And since the peak right here, well, the stock is down about 38%. And I'm accounting for the fact that they paid out 2 different dividends during that time period. Walgreens has a dividend right now of about just short of 3%. And I think this is a good thing to consider because that could be a good addition to the dividend portfolio. When we switch over to CVS's stock chart, well, during the same time period from the peak to recently, well, their stock was down about 31%. So not much better. And they also have their dividends in there. They have 2 dividends as well. But their dividend yield is a little bit better at about 3.5%. Now, this drop right here, this drop was right around earnings time, and they also got some analyst downgrades. And if we jump back to the Walgreens chart, well, we can see right here, this is when CVS announced their earnings, and then this drop right here, well, this is when Walgreens announced their own earnings. Now, I just wanted to point out how much investors tie these 2 stocks together. Okay, so now let's go ahead and try to value them. So we know that both stocks have fallen, but have they fallen enough to make them a good value? Let's start with CVS. So this is a chart of CVS's free cash flow, and the green bars are analyst estimates. I found those on Bloomberg. And essentially, I just took estimates for free cash flow, and now we're going to convert that to a discounted cash flow calculation. So we take our free cash flow projections from up here, we discount them by a weighted average cost of capital of 8.5%, then we apply a perpetual growth rate of 2.5%, and this gives us our fair value of 156,123. Now, technically, this is the value of the whole company, and this is the number we would use for both investors in bonds and investors in the stock. Now, generally, this is where I would stop, and we'll see a more in-depth look at how we did all these calculations when we publish our discounted cash flow video, and we'll be publishing that one soon. But for now, if all we care about is the value of the stock, then we can continue on. But if you're interested in the value of the firm, well, that's good for bond investors. Well, you can mostly just stop here. But for stock investors, so what we should do is we then take the value of the firm today and we subtract long-term debt. So in theory, this gives us the value of the equity. Now we take CVS's equity value, we divide that by the shares outstanding, and we get the fair value of the stock of about $64 per share. Okay, simple enough. Now let's switch over to Walgreens stock, and then we'll wrap it up with some charts. Okay, so we have the exact same concept here. In fact, I use the exact same weighted average cost of capital and the same perpetual growth rate. I could probably make the case for mixing these 2 up, but for what we're doing here, I think it makes sense to stick with the same ones. So for Walgreens, after running the numbers, we get a fair value of about $69 per share for Walgreens stock. Now, for both Walgreens and CVS, I kept cash out of this calculation. Now, for Walgreens, it wouldn't have made much of a difference since they don't have much cash, but CVS actually has a decent amount of cash, so it would have added a bit to their value. But technically, I could have added cash much like we deducted debt. Now, realistically, we should have added cash up here since this would in theory be available to both the bondholders and the stockholders. but I liked it to keep it off this calculation just to simplify the process a bit. And if anything else, it would simply make our calculations a bit more conservative. Adding cash would have increased the value of both of their shares. So sticking with what we have. So this is a chart of Walgreen stock. And right here, well, this is a line for our calculated fair value. Now, Walgreens is currently trading at about $54 a share, and we calculated the fair value to be about $69 a share. So from $54 to $69 is about 28% upside. Okay, looks pretty good. Perhaps the market oversold Walgreen stock. When we switch over to CVS's stock chart, well, the current price of CVS is slightly over $54 a share. And we calculated our fair value to be about $64 a share. So that's about a 19% upside. So once again, perhaps the market oversold CVS's stock. So should we buy CVS's stock or Walgreens stock? Well, for me, I can easily make the case that both of these belong in the value portfolio. The fact that Walgreens stock is trading at a bigger discount to our calculated fair value makes sense when you compare it to the current trading price of CVS to their calculated fair value, since I believe that CVS holds less risk than Walgreens does. So in theory, you're going to want to be compensated for that greater risk by buying it at a larger margin of safety. If you're curious about when to buy a stock, we actually did a video on that, and you can see a link in the description below for that. There we dive into how to apply a margin of safety to our calculated fair value. So up next in our Dow 30 series is to build these portfolios. Now, I actually plan on going ahead and putting both CVS's stock and Walgreens stock in the value portfolios, and probably the dividend portfolios as well, since I think that both CVS's dividend and Walgreens' dividend are safe. Really, what I'm likely to do is to combine these two companies into one position. So let's pretend that our average position size, our average holding size, is going to be 5% of the portfolio. What I would likely do is take these two and make them both 2.5%. That allows us to diversify a bit, and I think it'll better strengthen our position as investors to take on the industry headwinds. Give us a little bit of wiggle room, and I like where they are, broadly speaking, as far as where they are right now trading relative to our calculated fair value. So that's my move. What do you think? What's your move? What does your research show you about these two companies? Let me know what you think in the comments below. And don't forget to stick around, hit subscribe, because we're coming out with these portfolios and our valuation series is starting very soon. And thank you for sticking with me all the way to the end of the video. Hit subscribe, hit thumbs up. See you in the next video. Thanks.